Hey everybody, welcome back to the Economic Analyst channel. I know many of you have been worrying where have I been and why have I not been posting regular updates, and I've decided to make some changes to my presentation. Hopefully this will be an improvement, and moving forward this will result in a increase in quality from my previous videos while still conveying the same information to you, and hopefully it's a little bit more readable and you can see things better. In this video, to start off the new year of presentations, I want to go over some recent things that have been hitting the headlines about inflation, recession, and depression. There have been many commentators that have been worried about, the rising inflation and that it would cause a recession. And some doom and gloomers and perma-bears have come out and said that it could even result in another depression, like what we saw in the 1930s, or something as a combination of the 1970s and 30s. I myself have held a pessimistic view of the economy and have long believed that the rising inflation would lead to rising interest rates, and that would lead to a recession and could risk a depression myself. So I'm going to give you some of the updated data. Many of these charts you have already seen. Some of these you have not seen. And again, I'll be posting regular updates, but they probably won't be coming as often as I've had in the past just because of the new presentation. But hopefully this will still give you guys a satisfactory set of quality and information that you can use in your own life and prepare for what's coming ahead of us. So, let's start with what's going on currently. So, the number one predictor of the economy, of economic recessions, has been the yield curve, okay? The yield curve is typically measured as taking short-term interest rates and subtracting them from the longer-term interest rates, or taking longer-term interest rates and subtracting from the shorter. When you take long-term interest rates and you subtract from the short-term interest rate, which is what this chart shows here with the blue line, that will, if longer-term interest rates are lower than shorter-term interest rates, then that makes the yield curve negative, okay? So it means that there's like negative real rates compared from the longer end of the interest rate spectrum to the shorter end of the interest rate spectrum. And that typically is not supposed to happen. Typically speaking, longer term interest rates should be trading at a higher rate than shorter term, and it has to do with the availability of liquidity, of the amount of money flowing into those loans, and a risk factor that typically causes a normal curve on the interest rate spectrum to slope upward. So lower term interest rates are supposed to be lower than longer term. This graph here shows that there have been instances in the United States history, and this has been going all the way back throughout the 1900s, where the yield curve would actually become negative. Longer term interest rates are below shorter term interest rates. And when that has happened, it has been a very, very good predictor of economic recessions. Post-World War II, we've never had an economic recession without the yield curve going negative. And there has been, other than what had happened briefly in 1997, 1998, the yield curve also does not give a false positive. Well, a lot of the things that have been happening recently in the past month or two is that we've been seeing this yield curve turn negative again, which has led to many analysts forecast, and I believe this is going to be correct, of a coming recession. Now, many analysts and predictors are trying to say that it's going to happen in 2023. For reasons that I'll go into later on in the video, I don't think that's going to happen in 2023. I myself believe it's going to be in 2024 or even 2025, depending on how things play out, and I'll get into that in the next set of slides. Revealing the yield curve, many prognosticators and analysts think that this has something to do with the bond markets, where the buyers of bond markets, the investors in these bond markets, somehow possess this incredible knowledge that they know that a recession is coming. And so the thinking here is that they buy longer term interest rates, which is measured as in orange here, and they shrink these longer term interest rates below the shorter term interest rates, causing the yield curve to become inverted. So in other words, at some point, some economic data comes out Like, for instance, this is the 2008 recession that's been going on. Something comes out, and these investors who are buying typically long-term government bonds or 10-year treasuries, that's the traditional way of using the yield curve, is taking 10 or 30-year treasuries and subtracting it from short-term treasuries like the 2-year treasury rate, the 1-year treasury rate, or something like that. And that these investors somehow are able to buy these bonds at just the right time before the recession comes into play. So it could be lower profitability earnings from the stock market, could be economic indicators turning negative, whatever. But for some strange reason, many economists and analysts that don't pay attention to this can't ever see the recession coming. So where in the world do these investors get this magic knowledge? I, on the other hand, take a contrarian view, and I think it has more to do with this blue line, which is the federal funds rate. And I've said this in other videos, but I believe the federal funds rate is what is dictating the terms of the recession, and it just happens to be that when the federal funds rate is lifted above the 30-year treasury rate, that causes an economic recession. I mean, you can see it here, where back in 1990, the federal funds rate was above the 30-year treasury rate, so the yield curve was negative on that end, and we went into a recession in 90, 91, and 92. We see this happening again in the year 2000. We went into a recession in 2001, and of course, there's the infamous 2008 crash. We see where the federal funds rate was lifted above this 30-year treasury rate, and results of a recession. And so what's going on now? Well, the Federal Reserve has raised the federal funds rate above this 30-year treasury rate, causing those interest rates, causing that yield curve to turn negative. That looks like it's going to be a harbinger of a recession. And so while the yield curve is a great predictor of recessions, it doesn't really tell us how bad this recession is going to be. Sometimes the recessions can be relatively mild, like what we saw in 2001, where the unemployment rate lifted from 3.5% to 6%, and then we had a recovery afterwards. Other times, it could be a severe recession like what we saw in 2008 that precipitated a financial crisis and a very sluggish, bad recovery. So the yield curve is a great predictor of recessions, but it's not so great at predicting just how long, the duration of a recession, how bad is it going to be, what's the outcome of this, or any of the other really solid hard metrics that we want to get into to kind of see what's going to happen in the future. Many analysts are worried about the debt to GDP ratio. So this is the total debt in the economy versus GDP. Think of this like debt to income. GDP is national income, a statistical measure of how much income are we all earning for what we're doing at work and how much our businesses are making on the bottom line, okay? So the higher debt to GDP means that there's more and more debt relative to the same amount of income. And so therefore, the idea is that as debt to GDP increases, there's more and more debt versus the same amount of income, it becomes harder and harder to pay off that debt. And if income starts dropping, which is what happens during a recession, so there's been bad investments, bad loans that have been made into sectors of the economy that are no longer profitable, when income turns negative, that debt load becomes a heavier weight on the economy. And so that could be one way of measuring how bad an economy could get during a recession, okay? So if we take a look in 2008, the debt to GDP peaked off at around 375%. So however much income we were getting, we had over 3 times, almost 4 times that debt in 2008 at the height of that recession. And you can see that now the numbers here leading up to the recession are actually worse than that of 2008. So up until the recession that started to hit in 2008, debt to GDP was about 360%. Maybe almost 370 before peaking around this 375. And now it's about that 360%, and we're still a year to 2 years out. So by all measures, debt to GDP is actually a little bit heavier. Unfortunately, this alone can't really tell us much about the severity of a recession. And the reason why is because this is an aggregate statistic. The more aggregation you get, the more general look you get on the way that an economy works, when it comes to these aggregate statistics, but the less detail you get and the less ability that you get to really fine tune and see what's going on underneath the hood of the car, okay? So one of the reasons why this debt to GDP number is so large has to do with government debt relative to private debt. Now, government debt is often seen as being less risky than private debt. And the reason why is because a government can tax its citizens to pay off that debt. And so that's the reason why government debt interest rates for the same term and maturity is at a trade usually at a lower interest rate than private corporations bond interest rates, and especially private loans. Why? Because the government has access to a wider pool of resources and income to pay down that debt. And post 2008, we have seen a lot of government debt become a bigger and bigger portion of this debt load relative to GDP. And so even if the economy were to go into recession, outside of a sovereign risk scenario where the government enters total default, it is unlikely that this debt load by itself is a big enough predictor of a severe economic recession. So there's three components to tell you how bad a recession is going to be. There is the quantity of debt, which this aggregate statistic tells you. There is also the quality of debt, which this statistic and no real statistic can tell you. And then there's the cost of debt. And that's something that we can compile together. So taking out government debt and just taking a look at what private debt is, and I have aggregated private debt to income, and then have tried to project out the cost of debt based off of current interest rates. Now, this measure here is never going to be precise because no debt instrument is always in relative to current interest rates. So, for example, if a 10-year corporate bond came out and it's been lasting around for 5 years, well, then current interest rates are not going to dictate that corporate bond's rate of interest for that loan. Yet it has served as a very reliable indicator that during times of rising interest and rising debt relative to income, it has been a pretty good predictor of economic recessions going all the way back to the 1980s. So the 1990 recession, it was a very good predictor alongside the yield curve. Same is true with the 2000 recession. Same is true with the 2008 recession. And based off of Fed predictions to raise and hike the federal funds rate to 5, maybe even 6%, I'm looking at the burden, the interest burden, so to say, to reach that threshold that I have established here on this chart as economic stability. So right now, this is where the burden is right now based off of current federal funds rate and current market interest rates. But as the Fed continues to hike, this burden will increase and most likely increase over this stability threshold, indicating a recession. Now, this is the reason why I don't think we're going to see a recession in 2023, because we have not reached this burden threshold for the aggregate private sector. And this is taking into account private loans and corporate bonds together, which corporate bonds are a lot more resistant to interest rate hikes from the Fed than private loans. And that's really what's been keeping this threshold from being reached right there, is that even though the federal funds rate has been lifted, a lot of the debt that we have been seeing is from government debt, and that's not playing into a factor when it comes to the private economic stability right now. So it's still going to take some time. But by the time that the Federal Reserve hikes interest rates to 5, maybe even 5.5% on the federal funds rate, if they reach that level, that will trigger this threshold and will signal that the economy is having too much debt at those interest rates for it to handle and sustain that with its income, and will most likely lead to an economic recession. Again, it will take a year or two to play out. So my guess is that sometime in mid to late 2024 is when we're going to see our recession play out. Stripping out corporate bonds, we see a peculiar notion take place. We see here that loan delinquencies and defaults are really, really low, and that the default rates model is actually at a lower rate than what it was with corporate bonds. So in other words, the federal funds rate relative to debt, relative to the amount of private debt in our economy versus income is not at the levels that we were seeing in 2005, 2006 in the run-up to the 2008 recession. So there's still some time to manifest before we see Main Street start crumbling from the debt load. And the same is true from 2000 and 1980. So again, this is that economic stability threshold. But now what I have done is place this threshold on top of just private non-corporate debt. And I'm taking a look at that debt because that's like Main Street, okay? So Main Street is the major driver of our economy and is where most of the employees are working. And right now we're not seeing that cost and quantity of debt relative to income reach that threshold where it could signal a collapse in the economy. Now, again, the thing that this chart misses, statistics miss, is the quality of debt. So take a look at 2008. We do see that the cost and quantity of debt relative to income was higher than 2000, but it was about the level that it was in 1989, 1990, maybe a little bit higher. But look how bad loan defaults spiked year over year since 2005. And that shows you just how bad the quality of debt was in the mid-2000s from the housing bubble. I don't think that we're going to have a subprime issue with the amount of loans lent out in 2022, but going back to post-COVID, though I will say that there were emergency loans made out to people and businesses to tide them over during the wake of the pandemic in 2020. So the quality of debt could theoretically be as bad as 2008, but the cost and quantity of that debt hasn't reached those levels yet. And I would still say that that would be suspicious that it would be as severe as 2008 because these loans and interest rates were more fixed rate interest loans instead of subprime mortgages that were adjustable rate loans. That was the reason why we saw this huge, really terrible credit crunch in 2008. But does that mean that we're all just seeing things grow over time and that this coming recession is not going to be as severe? Well, probably not. And the reason why is because even though we may not see a recession develop that'll be as bad as 2008, the current economic situation could be as bad as 2008 or even worse. And the reason why is when we take a look at real gross output. So the common metric of an economy's performance has been real GDP, the bottom line. How much net income are we getting versus the prices that we are paying for that income, with that income on goods? But it does not measure the gross output, which is a better measure of total productivity. That measures how much producer goods are we making to create that final good. And when we adjust for producer prices, which went through a severe spike of inflation post-pandemic from the increasing in the money supply and the shutting down of production, we actually see that when we measure on the blue line, which is this real gross output, that the economy is not in a recession anymore, but it's actually in a depression. So what's the difference between a depression and a recession? Well, a recession is when the economy is actively contracting. It is actually reducing growth in over a period of time. So this pandemic, we see how the real gross output and real consumer output and real producer output, the two components that make up the real gross output, we see that contraction in 2020, and we are seeing growth. But if you notice, the level of gross output adjusted for prices compared to where it was pre-pandemic, we have not reached that level that it was pre-pandemic. And so now we're kind of in this dip, this bowl, this trough of negative growth compared to where we peaked out in the economy at the end of 2019. This, my friends, is a technical depression. We also saw depression post-2008, where the economy crumbled for nearly a year. It did recover in growth, but gross output levels actually did not reach 2008 levels until about, say, 2012 to 2013. And this doesn't account for the increase in population. This is not gross output per capita per se. And so if you take that metric, the measure was even worse. And so right now we've gone on 3 years where we have not regained the growth in the economy, the level of economic productivity and goods that we did since before the recession began. 2008 took 4 to 5 years before we got back to that level. We're on year 3 and counting. Producer prices have skyrocketed post-pandemic, which is something that I noted in the previous slide, and that's been the real metric that to why gross output is being held so low. So back on the previous slide, we could see that real consumer output, aka GDP, was growing, but real gross output was still being held down from these very, very high producer prices. And although we're seeing producer price inflation drop pretty spectacularly, and this is really good for economic growth in the long-term future, these high producer prices were still restraining and holding back that growth. And it was one of the reasons why I was very concerned in the early parts of 2022 and late 2021 that we were going to see an economic recession develop. Consumer prices have also hit a bout of rising inflation measured by this blue line. And unfortunately, wages have not been able to keep up post-pandemic. We did see a spike in wage growth in 2020 from all the stimulus spending, but the consequence of all that stimulus spending has been a spike in consumer prices, and wages are lagging to keep up. Now, consumer prices inflation is coming down, and we've been seeing that of note in the last 3 months, but yet still wages are still negative to consumer prices. So people are making less and less income on a real term basis compared to where they were on the pre-pandemic. And so as a consequence, real household net worth is negative. Now notice that real household net worth typically does not plummet unless if we're in an economic recession. There are times when there's a few quarters where real household net worth can turn negative, but this is something of peculiar note, is that the way that the economy is behaving right now is that even though it's growing, it's behaving in terms of net worth and how much assets and value of assets that households are accumulating. It's behaving like we are in an economic recession. Why? Because we're in a depression, much like what we saw in 2008. And that's driven from this high inflation. This is the worst household net worth growth rate that we have seen since 2008, and there's only been a few times in history where we've seen net worth levels reach this drastic sharp contrast compared to normal growth in household net worth from an increasing economy. So the worst one was in 2008, and then we saw a couple ones bad ones in the 1970s, and now we've got it in the post-pandemic world that we live in now. And when the recession sets in, this could cause the household net worth to turn negative for longer, even if the growth rate recovers somewhat. Now on the plus side, the money supply has going through an interesting phenomena. Back in late 2021, I had predicted that we were going to see 10% price inflation. And the reason why was because I was already factoring in that we were seeing rising inflation, rising prices, but I was assuming that the money supply would continue to grow, especially since the Federal Reserve was so hesitant to tighten the monetary standards in order to control this money supply growth rate. So I was assuming that the money supply, as measured as M2, would continue to increase, and that would result in higher bouts of price inflation. And I was even more confirmed on this when the war broke out between Russia and Ukraine. Yet shockingly, the money supply has actually contracted from where it was in the beginning of 2022. This is a very, very unusual phenomena. Typically speaking, due to bank creation and loan creation and Federal Reserve interest rates, we typically see the money supply continue to increase, and it is a very rare situation to see the money supply contract for longer than a year or stagnate for longer than a year. Very unusual what's been going on. But this is the reason why producer prices are coming down so hard and why consumer prices are coming down finally, and the consumer price inflation rate and producer price inflation rates are dropping. Now, comparing this consumer prices to business expenses, business expense index, this chart that I've created measured in blue compared to consumer prices in orange, I basically figured out that if you take wages growth and you take producer price inflation growth, you get the consumer price inflation number, more or less. And so the way that business expenses are driven right now, we're still seeing a gap between business expenses and consumer prices. So this tells me that there's still potential for an upswing in consumer price inflation, this is being driven by higher wage growth because workers are now saying you need to pay me more because my expenses are higher, and this will result in higher consumer prices going forward. In other words, the temporary dip that we're getting in consumer prices likely will not last. We will more than likely continue to see consumer price inflation, albeit the good news, at much lower inflation rate levels than what we were seeing in 2022. When we take a look at my consumer price index projection, I'm predicting that the consumer price inflation rate will probably end up around 6% by the end of the year. Now take note, this is just my projection based off the numbers. It looks like, and I say this very carefully, but it looks like that due to the recent dip in consumer price inflation rates, we may actually see the consumer price inflation rate dip well below 6%, say to 4% by the end of this year. But by the metrics driven by the producer price index for final demand and the business expense index growth rate, this gap here is suggesting that although consumer price inflation rates will come down, they'll still remain stubbornly high unless the Federal Reserve tightens at a harder rate than what they are doing now. And guys, that's all that I've got for this video today. I hope that you enjoyed this, and I hope this was valuable to you. I'll post more updates. Probably the next video that I'm going to create, this next presentation, will deal with how this is going to impact the financial markets, where investments are going to be placed, and what are going to be the performance outranks of those. So stay tuned for that video. Once again, guys, I thank you for watching this video. If you like my video, if you like the content that I provide, just hit that like button, drop me a comment, let me know what you think about all this. And as always, click that subscription so that way you're always notified whenever I do update and upload a new video. Make sure you click that notification bell so that you get it on your private media whenever I do create a new video. And as always, I thank you for watching this video. I'll talk to you next time.